So you've heard about the stock market, you want to get started, but you really don't know how. This video is going to show you start to finish, how to get set up with a brokerage, how to find good stocks to buy, how to place orders that will maximize your profits. And at the end of this video, we've got a huge bonus, so you want to stick around. We've got 3 stocks that you need to be looking at for a starter portfolio today. I'm Dan from Stocktrades, and this is our guide on how to buy stocks. So a few things before we start the video. Head down below, like the video, subscribe to the channel. We've got a ton of great content coming to you in 2020 here at Stocktrades, and you're not going to want to miss out. Before we learn how to buy stocks, I think it's important we understand why a company would issue stock. Typically, these companies are looking to grow faster than the rate they already are, so they need to seek capital to fund growth. So they would do this in the form of an IPO or an initial public offering. This is where shares would be distributed to institutional investors, and in the end, retail investors like you and I, we would buy the stocks, and in the end, the company would get the capital from the sale of the IPO. They would then use this money to fund growth, and ultimately, you would want their share price to go up from their initial public offering price, and in the end, the shareholders benefit for essentially funding this growth by buying the stock. Let's go over a few types of stocks that are available on the market, and one in particular that you want to look at and one that you probably don't. Another concept you want to grasp before you get started is the difference between preferred shares and common shares. For 99% of retail investors like you and I, preferred shares are not the avenue you want to go down, but we see a lot of new investors get kind of caught up in trying to find these high yielding stocks, and preferred shares often offer that. But some companies don't even offer preferred shares. You're not going to find them in every single company. And secondly, they trade more like a bond. You're not going to see them fluctuate like common shares do on the stock market. They more so fluctuate in price dependent on interest rates. So moving forward, you're going to want to be looking at common stocks, not preferred stocks. Just like you can't golf without golf clubs, you can't buy stocks without a brokerage account. There's rare instances where you can buy directly from the company themselves, but to make your life easier, you're just going to want to open up a brokerage account. And the number one brokerage we recommend here at Stocktrades is Questrade. I've been a client of Questrade's for about a decade now. In terms of commissions, in terms of trading platforms, the interface, viewing your portfolio's results, customer service, they're best in class. I don't think anything else here compares. And if you were to head to a bank, you'll probably pay double, if not more, the commissions. Below, we're going to offer a code where you can sign up with Questrade and get $50 in free commission. And I'm actually going to swap over here, and I'm going to walk you through step by step how to open an account with Questrade. So let's get started. So opening up a Questrade account is pretty easy. We're going to head over to questrade.com. Before we open an account, I'm just going to show you the commission structure here. So Questrade offers some of the lowest commissions out of all the discount brokerages. I think the only one that's lower is Interactive Brokers, but they have a much higher account minimum. Questrade, you can open an account with just $1,000. So if we go in here to their commissions, their stocks are penny a share, but there is little stipulation of this. The minimum is going to be $4.95, and your maximum is going to be $9.95. So if you purchase 20 shares in a company, you're going to get billed $4.95 commission, and if you purchase 700 shares in a company, you're going to get billed $7. Their ETFs are free to buy, not all ETFs, but most. To sell them, it's the same structure as the stock, $4.95 minimum to a maximum of $9.95. Options, if you want to get into selling or buying options contracts, it's about $10 a contract, $9.95. Mutual funds we won't get into. Bonds and GICs are $5,000 minimum. And IPOs and new issues are free to buy with a minimum $5,000 purchase. So to open an account, you're just going to head up here to the open an account button. You're going to see a variety of account options here. This Quest Wealth, this is essentially Questrade managing your account. If you're looking to become a self-directed investor, you probably don't want to choose this option. Although if you're looking to move from a bank and still have your money managed, Questrade does offer lower fees than your normal bank would. And as we head up here, you can open a Forex account if you want. And if you don't know what a margin account is, it's essentially your brokerage letting you trade on margin. So it's with leverage. If you have a $5,000 account, they might let you trade with $10,000 or $15,000. I wouldn't recommend this to new or even experienced investors. It can get pretty sticky at sometimes if you've lost some money. Questrade has the ability to essentially immediately liquidate your position to recover the money you've borrowed. And not to mention, money you've borrowed also is charged interest. So if you have a $5,000 account and you're using $5,000 of Questrade's money, they will charge you interest on that money. For the purposes of this video, we're going to be opening up a tax-free savings account. So you click the plus button. You can open multiple accounts if you want. You can open an RRSP. Over here is where you would add our discount code, which is RX4RBZMB. So that's going to give you your $50 in trade commissions. You're going to agree to the conditions of opening an account. And now we're going to create a user ID. You're going to enter your first name, your last name, your email, and your phone number. And now you're going to create a user ID. You want to make this simple, but you want to make it unique as well. And a password. So now these security questions, you're going to want to make these things that you definitely will not forget, because Questrade has quite an advanced security system. If you enter your password wrong twice, they'll lock your account and you'll have to go through these questions to get back in. So you want to make these something you will definitely remember. After you've gone through this, it's going to get to the point. This is essentially all we can go through in the opening of an account. I'm not going to get into filling out all this information. You can do it on your own. It's pretty self-explanatory. But they're going to want personal information, social insurance number, stuff like that, your address. They're going to want where you work, your net worth, your financial assets, and your citizenship. This is a registered account, so it's through the government. It's a tax-free savings account, so they just want to know this information. That's pretty much it for setting up an account with Questrade. We have another video, which I'll link to in the description, about actually navigating Questrade's platform and making buy and sell transactions on their desktop platform as well as their browser-based platform. So yeah, that's pretty much it with opening an account. So we know we're looking for common stocks, and you've opened up your brokerage account. The next thing to do would be to fund that account if you haven't already started the process. Typically it takes 3 to 4 days for the money to hit your account, and after that you'll be good to start buying stocks. But chances are you're going to log in, you're going to go to the platform, you're going to go to buy your first stock, and you're going to be overwhelmed with the amount of order options you have for each stock. So let's dig into some of the order options, some that you want to use, and most of all, one that you never want to use. So the first order we're going to get into is the most common order type and the number one order type that I would recommend investors not use, and that is the market order. The market order is essentially an order that says, I want it now and I want it fast. So if you want to buy 100 stocks of a company and you put a market order in, you're essentially telling your brokerage to buy 100 stocks for whatever price is listed. This order gets dangerous. Typically when you're buying stocks with low liquidity, you can have a large gap in the bid price and the ask price. And the bid price is what somebody is willing to pay for a stock, and the ask is what somebody is looking to sell a stock for. So if you're looking for a stock that's $25 and you put in a market order, but the only person willing to sell their stock has it listed for $28, you're going to put that market order in and your order is going to be filled at $28, and you're going to end up paying $3 more a share than you would have liked for that stock. This is why it's important that we practice not using the market order and we instead use the order we're going to talk about next. A little highlight on the market order: it's probably not going to get you into too much trouble if you're buying major Canadian stocks that have a ton of volume. The bid and ask price are typically only going to be within a few cents of each other. So if you put a market order in for $100 stock that has a high volume, you might get your order filled at 102 cents or 103 cents, and it's not going to make that drastic of a difference. The limit order is something that we want to be using on every single one of our trades, and the main reason is because it protects our price, whether we're buying or selling. If you own a stock that trades at $20 and you'd like to sell it, if you put a market order in, you open yourself up for your brokerage filling that order substantially lower than the price the stock trades at. So if you put a market order in for $20 and somebody has a buy order in for 19, your brokerage might fill it with that position and you'll lose $1 a share essentially. The same goes with buying. If you're looking to buy a stock and you put a market order in, there is a chance that your order could be filled substantially higher than the stock's list price. So if you're looking to buy a $100 stock and you'd be comfortable paying $102 or $103 for this stock, put that in as your limit order. The worst case scenario is that it won't get filled because the ask price is higher, which in the end is ultimately going to save you money, and you'll be allowed to wait for a better chance to get in. The third and final order we're going to talk about, and one that I use all the time, is the stop limit order. Now it's important to not confuse the stop limit order with the stop loss order. Here in Canada, we're actually not allowed to use the stop loss order. You're not going to find it on your brokerage in Questrade, in any other Canadian brokerage. And the reasoning for it is it doesn't provide a lot of downside protection. And let's go over an example here to show you what I mean. If you were to buy a stock at $20 a share, the stock price has gone up to $30, and you want to protect some of those gains. You've earned 50%, but you don't have time to watch the stock all the time. The stock may fall on a poor earnings report, and you want to lock in some of those gains. With a stop loss order, you would place an order to sell the stock when it hit $25. So what this will do is your brokerage will track the stock's price, and once it hits $25, your brokerage will put in a market order to sell the stock. And this is where the stop limit order comes into play. Instead of a market order, the stop limit puts in a limit order. So if you want to sell the stock at $25, you have to set a limit to how low you're willing to go to sell the stock. So if you put a stop limit order in at 25 and your limit is 23, your brokerage will execute the trade below 25 but won't execute the trade if it goes below 23. That's the key difference between a stop loss. If you were to just issue a stop loss, it's a market order. So if you have a stop loss at $25 and the stock gaps down to $19, $20, it's going to execute the market order and you're going to sell it for that price, which isn't what you want. In the end, stop limit orders, they protect you a lot. They protect your gains. I use them all the time. Most recently with Shopify, the stock had gone up nearly 200% here in 2019, and I just wanted to protect some of those gains. So every so often I go on and I place a stop limit order, and if the stock were to fall, my stop limit order would be executed. I would gather some of those profits, and I could potentially buy back in if the stock were to fall even further. And you're typically only going to use the stop limit order to sell stocks. You can use it to buy stocks, but that isn't really in the scope of this video, this guide, because typically when you're using a stop limit to buy stocks, it's to protect a short position, and we wouldn't recommend any new investors short sell stocks. We're eventually going to post a video here about short selling stocks, a guide as to how to go about it and how to protect yourself as best you can, but for now, I would not suggest it, and the stop limit order should typically be used for selling stocks to protect gains. So you've signed up with a brokerage, you've started to fund the account, I've showed you some orders to use and not to use, and now you're pretty much ready to buy stocks. The only thing you need to learn now is how actually to evaluate a stock. And we're going to go over some key points and key metrics in this section of the video that should give you a basic grasp of figuring out whether a stock is overpriced or underpriced. Now, after you watch this, if you're looking to take it up another level, I've included a link in the description below for a guide that we offer, a company analysis guide. It's a 5-part guide, and it is going to go much more in depth in analyzing a stock's value, their potential growth, taking a look at their industry, analyzing that type of growth within the industry and the market in general. But for now, let's just take a look at some basic metrics. And the first one we're going to look at is the price to earnings ratio. The price to earnings ratio is probably the most popular and the most overused valuation metric by new investors. And I'm here to tell you that in and itself, it's really not that useful. The price to earnings ratio essentially takes the stock's current price and divides it by its earnings per share. So a stock trading at $15 with earnings per share of $3, 15 divided by 3, you have a price to earnings ratio of about 5. Now, the reasoning that this ratio is not very useful in and itself is, take Royal Bank, for instance, a major company on the TSX, financial company. They have a price to earnings ratio of around, it usually hovers around anywhere from 12 to 13. Whereas you look at a company like Constellation Software, who has a price to earnings ratio of, it can be anywhere from 30 to 80 times earnings. How do you know which one of these companies is over or undervalued? You're comparing a stock in the financial industry to one in the tech industry. That's why it's important with the price to earnings ratio, you look at the industry averages. So we can take Royal Bank, for example, with a price to earnings of 12 and compare it to the average price to earnings ratio in the Canadian financial sector, which is around 12.5 to 13. And we can take Constellation Software and compare it to the price to earnings in the Canadian tech industry, which is currently around 280 actually. So if you look at them now, even though Royal Bank has a lower price to earnings ratio, it seems that right now Constellation Software would be the better option in terms of price to earnings. That's pretty much it for the price to earnings ratio. The next ratio we're going to go over is, it's a little unique. It's more so looked at for growth stocks, but that is the price to earnings to growth ratio. Let's take a look. The price to earnings to growth, or PEG ratio, what I'll be calling it moving forward, is essentially a small enhancement on the price to earnings ratio. All we're doing is taking the company's price to earnings and we're dividing it by their expected growth rate over a period of time. So a prime example would be a company with a price to earnings of 10 and an annual growth rate, expected growth rate over the next 5 years of around 5%. We would take that 10, we would divide it by 5, and we would come up with a PEG of around 2. Now, with a PEG, you optimally want a number around 1. Lower than 1 is better. Above 1 is, it's still good, but once you're hitting the 2 range, you're probably looking at a stock that has a little too much growth priced into it already. The next ratio we're going to look at is the debt to capital ratio and the return on equity ratio. The debt to equity ratio is calculated by taking the total liabilities and dividing it by the shareholders' equity of the company. And shareholders' equity is essentially assets minus liabilities. That's not something we're going to go too far in depth with in this video. For right now, you can find the debt to equity ratio on most financial sites, Yahoo Finance, Reuters. We even have it over at stocktrades.ca if you pull a quote. But essentially what you're looking for, the lower debt to equity, the better. If a company has a high debt to equity, they might not be able to fund growth through loans and instead might actually issue shares to fund growth. And as soon as the company issues shares, the shares outstanding go up, the stock price is diluted, and as such, typically the stock price falls. Companies with higher debt to equity are generally riskier investments in terms of, in the case of a downturn, they have a lot of debt, a lot of interest-bearing debt. So typically you're going to look for companies with lower debt to equity, but this is also much like the price to earnings ratio, where you need to look at the industry as a whole. There's a different amount of debt that's considered healthy in different industries: financial, technology, healthcare, oil and gas. So you want to take the debt to equity of the company you're looking at and compare it to the industry averages. Our next ratio, return on equity. The return on equity ratio is essentially to judge the effectiveness of management to turn a profit with the assets they currently have. The return on equity is calculated by taking the net income and dividing them by the shareholders' equity, which is, of course, as we talked about before, assets minus liabilities. Now, typically when you're looking at return on equity, it's good, again, to compare one stock to another stock in a similar industry. For example, a utility company is going to have a lower return on equity than, say, a technology company, because utility companies have a lot of assets and a lot of debt and a lower amount of net income, and as such their return on equity might be lower. It's good to look at historical returns on equity as well. Get a few years, 3, 4, 5 years of historical numbers under the belt to really show you if this company is outperforming the industry or outperforming the other stock you're comparing it to. So that's pretty much it with our guide to buying stocks. I mean, I walked you through how to sign up with a brokerage. I showed you what stocks you should be looking at: common shares, not preferred shares. I showed you some order types you shouldn't be using: the market order, and should be using the stop loss and limit order. And I showed you some valuation methods: the price to earnings ratio, the PEG ratio, debt to equity ratio, return on equity ratio. And I know these are kind of hard to digest at first. You can do a lot of research on them themselves, or if you really don't feel like calculating them, you can just head to a website like Stocktrades, like Reuters, and find the numbers yourself. As a bonus, like I said, we're going to go over 3 stocks that you need to own today in a starter portfolio, or at least need to consider owning. These are some of the best Canadian stocks on the market. They've raised dividends for multiple decades. They're in some of the strongest industries in the country, and I own all 3. Let's get started. So the first stock to buy, TD Bank, trading under the ticker TD. TD is the second largest bank in the country next to Royal Bank, and they have the strongest presence in the United States. They're actually deemed, even as a Canadian bank, one of the most convenient banks in the United States. And the company is the only Canadian Big 5 bank that maintains a double-digit 1-year and 5-year dividend growth rate. The company yields around 4%, and they have a dividend growth streak of 8 years. They've raised dividends pretty much every single year since the recovery of the 2008 financial crisis. One key thing to note, that during that financial crisis, when the large majority of companies were slashing dividends, cutting dividends, the Big 5 Canadian banks held on. They maintained their dividends. They didn't raise them, but they at least kept them the same. There was no cuts made, which is a strong indication that the Canadian financial sector is one of the strongest in the world. Let's move on to our next stock, which is a utility giant that has raised dividends for over 40 years. The second stock on the list is Canadian utility giant Fortis. Fortis is a top 15 utility company in North America, and they have operations in Canada, the United States, as well as the Caribbean. The company has raised dividends for 45 straight years, and this is the second longest streak in the country. The only one that beats them in this area is Canadian Utilities at 47 years. The company's 5-year and 1-year dividend growth rates are quite small. Their 5-year is 6% and their 1-year is 5%. But the thing you need to look at here is consistency. You're getting a 5 or 6% mid-single digit dividend increase every single year for the last 4.5 decades. Reliability and consistency is key. Utility companies tend to thrive in lower interest rate environments, typically because they're borrowing a lot of money to build and develop infrastructure. So the cheaper they can get that money, the better. And this is why at the end of 2019, at least, Fortis is a stock that you need to look at for dividend growth as well as reliability in the case of an economic downturn. Let's take a look at our third stock, which is an oil and gas company with a great dividend growth rate. The third and final stock on our list is Canadian oil and gas giant Canadian Natural Resources. Why have I included CNRL? Number one, they're taking advantage of a very weak oil and gas economy right now. And number two, they pay one of the best dividends in the country, the best dividend in the oil and gas industry by far, excluding pipelines. In 2017, Canadian Natural purchased Shell's Canadian Alberta oil sands assets, and earlier this year they purchased Devon Energy's Canadian assets as well. Second of all is their dividend. The company pays around 3.7%, and the best thing about them is they have a 5-year dividend growth rate of around 18%, and they've raised dividends for 18 straight years. So with a dividend growth rate of around 18%, their dividend is essentially set to double every 5 years, and you can count on it with a near multi-decade dividend streak. So that's pretty much it for our video. We've done the how to buy stocks. We've given you the 3 bonus ones that you need to look at for your portfolio today. The last thing I ask you to do is, again, like the video, subscribe to the channel. We got a ton of great content coming out, and we don't want you to miss our next video. I'm Dan, owner of stocktrades.ca, and I'll see you next time.